Welcome back to Kitco News and Happy New Year, everyone. I'm Jeremy Safran. Well, Goldman Sachs is revising its outlook for gold, pushing back its forecast of $3,000 an ounce from this year to mid-2026. Now, the change comes amid expectations that the Federal Reserve will take a slower approach to cutting interest rates. Inflation is already setting the tone for 2025 with the latest producer price index report showing a smaller than expected rise of 0.2% in December. Now, at first glance, this might sound like good news, but here's where it gets interesting. Energy costs surged, with gasoline prices jumping nearly 10%, and core inflation, which excludes food and energy, stayed flat. So where does this mean gold will go, and what does it mean for your investments? Could this set the stage for one more dip in gold before it moves higher, or is that $3,000 level off the table? Let's dive into the charts with Gary Wagner, of course, editor of thegoldforecast.com, one of our favorites. Gary, welcome back to the show. Happy New Year, my friend. Great to see you.
Happy New Year. And yes, it's great to be here, and it's a new year, and I'm excited. I'm excited as to what we'll see unfold this year.
Me too. I hope your holidays were good. I got married, Gary, so we're starting the year fresh over here. Speaking of starting the year fresh, gold is up 1.7% so far this year, holding steady at current levels. But I know I was talking to you before, and you see a short-term dip on the horizon before prices rally above that $2,700 mark again. So let's talk about it here, Gary. What's driving the outlook, and what's the technical story behind it?
Absolutely. Absolutely. If you recall, I believe we did our last interview second week of December. And at that point, we were fully immersed in a correction. If we can pull up our daily chart, we had hit the all-time record high back in October. And we had this tremendous move down from 2,800 to below 2,600. When we talked last, we were looking at this move back up, what I labeled as a B wave. And I talked about the good and the bad. And in terms of the good and the bad, what I mean is I still believe that we are in a correction, although we are in the final stages of that correction. And the exciting part is once the correction concludes, and I don't see that taking that long to unfold. In other words, I believe it'll happen the first or second month of this year, March at the latest. Then we restart the clock in terms of our Elliott Wave count. And that means we will, according to Elliott Wave theory, take out $2,800 minimum by the conclusion of what we're labeling as the next motive or impulse cycle. In terms of what we witnessed recently that I found interesting is if you see this green candle that I'm pointing to, Friday, January 10th, and that's when the jobs report came out. And they were anticipating a fairly tepid report, 160,000 new jobs added to payroll, and it came in well above expectations. And that would typically be bearish for gold. But what we saw was gold actually moved up and moved above this upper level resistance line. I think what we saw was a delayed or knee-jerk reaction to the jobs report, because yesterday we had that double-digit sell-off in which gold lost almost $40. And so now it's back within this compression triangle. My sense is that we could have one more move down this final E wave, and that could take us anywhere between 2,650 and 2,630. But after that concludes, we will then go back into our impulse phase or motive phase, and that will take gold higher as we move into the second quarter and beyond this year.
Interesting. Okay, so obviously we'll get that dip, and I got to ask you, Gary. I mean, if we do see that dip that you're talking about before we see this come to fruition, another little bit of a hopefully some profits. I mean, what should investors watch for to confirm that the rally is underway in the charts, like you mentioned there? Just because the last time we saw the dip, we thought maybe it was the last one.
Well, the last time we talked, I said that we would get a C wave down, and that could go as low as about 2,600. That's exactly what we saw. I would expect this correction to be shallower than the previous one. And the way that we want to look at it, as a market technician, we've got a series of highs. We have lower highs, 2,800 here, 2,750 here, and then 2,714. We'll round it down to 27. So we've got a market that's got a series of lower highs, but we also have higher lows, 2,570 here, 2,602 here. And so what we want to do to confirm that the correction is over, we want to look at these price points, meaning 2,575, 2,600 as major support. If we look at this lower level support line that's just created from drawing a line from a series of lows here and carrying it forward, we should get some sort of confirmation if gold, as I believe it could, continues to sell off. Then we want to see either a candlestick pattern, or we want to see how it reacts, for example, here at 2620. And then we have a series of lows here at about 2640. So if it continues to move down, we want to see that V or pivot from bullish to bearish. And typically what you look for is a color change in the case of a correction from red to green. If we convert this to our what's called a Japanese average, it's a little easier to read, or Japanese average. You can see that as gold had this one leg of the major correction, candle size got smaller, and then you had your pivot. The pivot meaning a color change from red to green. As it moved up, we had from green to red, and you can see that down here, you had large bodies in terms of the candle size, and they got very, very small, telling us that we possibly have bottomed. This particular leg of the rally was slow to start, but it did pick up steam and traded as high as 2709, and that was just last week.
Yeah, well said. Okay, let's shift over to the U.S. dollar index, because you and I were speaking before coming on the air, and you highlighted the potential for the dollar to climb to 113 before hitting major resistance. So what makes this level so significant? And let's talk to the audience. How does it tie into the gold story?
Well, the one thing that I find amazing, and let me go ahead and blow this up a little bit, because what we're focusing on is this high that came in November and October of 2022. When we look at what the dollar has done recently, it's been range bound between about 106 on the high, with support just around 100. But if you look at what happened in September of 2024, we started climbing in the same way that we climbed back in July of 2023, in which, in terms of the value of the dollar as it is compared to the basket of currencies it trades against, it went from 100 to recently 109. And that represents a 9% additional value when compared to the basket, the euro. There's 7 other currencies that the dollar index is kind of paired against. And so we saw the other currencies not fare as well. And you had incredible dollar strength from October and September of last year to current pricing. And at the same time, we saw gold move substantially higher up until October of last year, because what we saw then was $2,800 gold. So we had dollar strength, and we've had gold strength happening almost in perfect sync. They go out of alignment, but you get the rare quality of them both moving to higher values. And as I've said before on the show, that is a rare occurrence and tends to only happen when you have Federal Reserve intervention. heavy changes in monetary policy. And that's what we've seen over the end of last year and into this year.
Yeah, and we continue to see where that's going to be driving into 2025. Okay, finally, Gary, you mentioned key technical levels for gold and then there the dollar index, but what about market sentiment? I mean, it seems like it's waned a bit. Are traders underestimating or overestimating the potential for a breakout in gold? I mean, I guess the question is how much of these moves are being driven by fear versus fundamentals?
Well, let's look at the fundamentals that drove gold higher and ask one simple question. Are they still in the marketplace? Are they still causing the potential for uncertainty, geopolitical? And I'm talking about the Middle East, Russia and Ukraine. Those two conflicts have not resolved. The negative is that you really saw strong tailwinds for gold as the Federal Reserve began to cut rates, because gold doesn't bear interest. So when compared against fixed assets, lower interest rates makes gold more attractive. Higher interest rates makes gold less attractive, excuse me. And so we still have the potential for geopolitical uncertainty. And then let's move to political uncertainty. We have a new president coming in, and there's a couple of things that could challenge both the levels of inflation as well as our budget deficit. And both of those are items that gold is very sensitive to. In other words, a larger deficit would create tailwinds, bullish tailwinds for gold. Inflation ticking up would in fact do the same thing. And that brings into tariffs. And that's an important thing that we should touch upon.
Yeah. Well, okay, I'm going to talk to you about tariffs, and I want your macro take because we're kind of, as you mentioned, in the in-between here, waiting for January 20th. But silver has been outperforming gold so far. It's up 4% year to date. So what's your take on silver's trajectory? Could it follow gold's lead into the second half of the year?
Well, when we look at silver last year, it did something it hasn't done in a decade, which is really break above 30. I'm trying to compress it to bring in some data. So if we look at 2024 and if we look at 2023, you can see that silver was really caught in between $20 on the low end and $28 here. In fact, silver didn't break above 30 until April of last year. Then it hit a higher top at 33 and eventually hit a price point we haven't seen, I believe, in about a decade, which is silver at about $35. So I believe that silver has some room to the upside in terms of our Elliott Wave count. We believe that unlike gold that is still in the midst of a correction, silver could have potentially completed the correction when it traded down to $29 on the way down from $35. And if that's the case, we've entered what's called a new impulse or motive phase, waves 1 through 5. And typically the theory goes that at the conclusion of the fifth wave, and I don't have a time element, nor do I have specifics about the waves, because you really need wave 1, which we use as a benchmark wave, before we can be more decisive. But we should conclude above $35 an ounce when this motive phase completes in silver.
Yeah, a lot of people waiting for that one. Okay, let's get back to the macro take here, because you just kind of mentioned a little bit of what we've been seeing since I last talked to you, Gary. There's possibly some macro surprises that investors should potentially gear up for. I mean, many analysts on Wall Street don't see the Federal Reserve cutting rates in January, March, May, or even June at this point. Now, that's due in part to what you mentioned, this latest blowout U.S. jobs report that showed the economy adding 256,000 jobs and crushing estimates. And the unemployment rate also dropped to 4.1%. Now, we do know that these numbers often get revised later down the line. And of course, just before Trump takes office here, we're getting these latest numbers. So what's your macro outlook given this?
Well, one of the things that the Fed has been focused upon is they were solely focused upon getting inflation to their 2% target.
Right.
As they did that, the labor market began to cool. So they wanted to make sure that they supported the labor market. The last jobs report tells you that the economy in the US is strong, it is vibrant, it's running on at least 6 or 7 out of 8 cylinders right now. I mean, coming in at 256,000 jobs added in December. So that bodes well for that. However, at the same time, the Fed made a tremendous revision to their monetary policy where we were expecting what we call interest rate normalization, where they had moved interest rates up beyond 5%. And as inflation began to tick down, they began to cut rates pretty aggressively at first. And then the big surprise at the December FOMC meeting, and prior to that, statements that Powell had made that they're not in a hurry, they don't want to rush it. In other words, that they were going to slow the pace of rate cuts. Initially, we were looking for 3 this calendar year, and now it comes down to whether we'll see 2 or maybe even 1. But as you correctly pointed out, the interest rate cuts that the Fed enacts this year will be dependent on the most current data. Mm-hmm. And so we'll have to see where that data leads us to, because with a new administration, with tariffs, and also concerns about whether Trump will show fiscal prudency or whether he will, like last time, spend more than the country takes in, which is what every president has done, but it's to what degree. And will inflation, which has now become sticky, in other words, we saw great results as inflation came down from the records in 2022 at about 9% and started to go into the 3s, which is where we are. But now there are some things that are sticky or persistent. As you mentioned earlier, energy being a large one of those components. If inflation is troublesome, then the Federal Reserve is going to want to put a cap on economic growth, so to speak, so that inflation comes more in alignment with their 2% target. And so that's the question, the $64 million question that we don't know is, will there be more inflation? Will that inflation be persistent? And how the economy will work and what the Fed will do as a result of that.
Right. Yeah. And a lot of people asking what this data revisions will look like when there's a new administration in the White House, too. Okay, Gary, you and I just talked about this slower monetary easing. As I mentioned off the top, Goldman Sachs analysts have walked back their $3,000 gold forecast from this year, moving it to 2026, rather. Now, they're now projecting gold prices reach $29.10, announced by the end of this year in 2025. Goldman's economists have also adjusted their rate cut projections this year, lowering the forecast from 100 basis points to 75 basis points. What's your take on this? I know you and I just talked about that next rally potential to $2,800, but is the top for gold this year a gain of less than $300?
Personally, I don't believe so, based on both the technical indicators that I am looking at, as well as the fundamentals at play. If President-elect Trump is true to his commitments to implement tariffs, those could create tremendous inflationary pressures. If that happens, it will cause the Fed to act one way, and inflation is an environment that gold tends to do quite well. As long as the conflicts, the geopolitical conflicts, are still fully embedded, and it doesn't seem as though they're slowing down when we look at what's going on in Russia and Ukraine. Russia's been devastated by the amount of troops they've lost. At last count, it was possibly as high as 500,000. but they are now bringing in the North Koreans. They have Iran manufacturing drones for them and China funding the war, because all of those countries believe that they'll benefit from knocking America down a notch in terms of its stability as a world power. And when you've got the kind of power that you could have, especially with China and Russia aligned, with Iran being kind of a proxy of them, and then South Korea coming in, you've got the potential for the conflict in Ukraine to accelerate rather than come to a peaceful resolution as we all hope for.
Right.
In terms of the Middle East, that is still, although it's gone out of the news cycle, it's still fully embedded, and it hasn't come really closer to a conflict than when they began over a year ago. And so those are troublesome problems. I personally see gold not only taking out 2,800, but my numbers have been about 2,900, with the upper level possible being 3,000. And what I'm basing that on is the various legs of the rally. Back in October of 23, gold was just under 2,000. And from there, it ran to 25.35. So it ran roughly $500. Then it entered a correction. The correction took it back down to about $2,380. And from $2,380, it ran to $2,800. So we saw a $500 rally,
Right.
and then we saw a $400 rally. If gold, as I believe it could, trades as low as 2,600, if we add 300 to that, we're at 2,900. If it comes closer to the rallies that we saw at the end of 23, all the way up to, call it, the middle of May, and then when the clock restarted, so to speak, in July, we had gold at 2,400, and it went up to 2,800. That's a $400 move of the smaller of the two rallies. So if we take 400 from 26, we do get to 3,000. But I think that this new call is pretty concise in terms of when we might hit 3,000. I wouldn't be surprised if it did take till the first quarter of next year, 2026. But I think we most certainly will test 2,900 at some point this year in gold.
All right, well said. Okay, well, we have to discuss this issue of tariffs. I mean, I must bring it up. Just a little bit of background for the viewers. U.S. President-elect Donald Trump is set to obviously return to the White House on January 20th. Now, he's making headlines with promises to impose new trade tariffs, including a 25% tariff on Mexico and Canada and an additional 10% tariff on China. Now, analysts warn that these tariffs could spark trade wars and, much like you said, Gary, reignite inflationary pressures, of course. Now, all the key words are here is that tariffs on all imports are universal, right? Tariffs on targeted countries. The one big unknown is whether precious metals will be targeted, Gary. This could have a massive impact, and we don't expect clarity on this, of course, right away. I should also note that, interestingly, we're already seeing metals flowing back to the U.S. I know that our own Ernest Hoffman reported on this. Of course, a sharp reversal from post-COVID trends when they were predominantly moving from the west to the east. Now, the shift began on November 20th when Trump announced the potential tariffs. Since then, COMEX warehouse stocks have surged up by 4.4 million ounces for gold, 16 million ounces for silver, and 133,000 ounces for platinum. Now, physical metals are being presumptively shipped to the U.S., driven, of course, by looming threats of tariffs and what that means. This, of course, is the latest information by MKS Data. Gary, you've been doing this a long time, my friend. Elaborate on whether this could happen. I mean, explain why precious metals have been exempt from tariffs in the past.
Well, what I can say is it's a huge unknown. We have seen for not the most part, but on many occasions, Trump make a pledge that he's going to do something, and then he does try to accomplish that. And if in fact what we see is that he implements tariffs across the board, that could create trade wars, as you said, but huge inflationary pressures, because as tariffs are added to the cost of goods, that takes the cost of goods up, and that is intrinsically the definition of inflation, paying more for the same item as you did previously. Now, when it comes to the precious metals, as you pointed out, they have been, for the most part, exempt. We'll have to see how that unfolds. If that's the case, that throws yet another possibility and another potential to move the metals higher and create those bullish tailwinds. The fact of the matter is, if our inventories are picking up in terms of physical in the United States, initially, supply and demand would dictate that could pressure them lower because our stockpiles, our inventory is greater. But inevitably, if they have to add a surcharge or a tariff as they import precious metals, that would have profound implications on what we could see in the price. One thing it will do is create extreme volatility, regardless of where the metals go from day to day. But they certainly could have a genuine impact overall on the price of gold, silver, platinum, to a smaller extent, palladium this year.
Yeah, interesting. And you mentioned, if it does happen, we could see some prices going up or down, at least some volatility. How long does that lagging effect usually take place?
Well, we won't really know until President-elect Trump becomes the next president and what his first steps are in terms of his new administration. We do recall from the last election when he was president, he was fairly quick to immediately implement certain things, certain pledges he had made. And I wouldn't expect him to be different now than he was then. If he is quick to begin to implement these things, specifically tariffs, because the budget deficit in terms of growth we would see throughout the year and throughout his term, not necessarily right at the beginning, but the tariffs would have an immediate and profound impact on the cost of goods. If he does make good on his pledge to be heavy-handed with tariffs, we could see a major uptick in inflation. We know what higher inflation does for gold. And until it unfolds, I don't really want to make comments because it's an unknown.
Yeah.
But he has implemented tariffs in the past. They, of course, in many occasions were repealed when Biden came in. But if he reinstitutes and has a heavy hand with tariffs, we could see inflationary pressures really move up and move up quickly.
Yeah, well said. Well, let's wait and see. January 20th coming very quickly. Gary Wagner, of course, editor of thegoldforecast.com. Thanks for your insights, my friend, as always. Your accuracy last year was impressive, Gary. It helped steer investors to some good profits. So here's to keeping that momentum going this year in 2025.
Thank you so very much.
Thank you again for watching, and don't forget to hit the subscribe button. I'm Jeremy Saffron, and for all of us here at Kitco News, it's great to be back in the studio. Stay tuned for lots of exciting content, including our recent coverage of the Vancouver Resource Investment Conference coming soon. We'll see you next time.